Tyler. Thanks for being here. And next I'll introduce Lisa. She's on the phone. She's not on video, but pay attention to, to the audio that comes through. She's been in real estate for, I don't want to say decades because it makes you sound old, but your track record is just like, which you're not.
I was like 10 years old when I got started.
Yeah, she's been in real estate for a long time. How would I say that? Her whole career, and she has some amazing results for herself, her family, and for investors. And when I first met her and I saw her track record, I was like, what? Are you serious? That is insanely impressive. I will partner with you for sure. She's fantastic to work with. She lives in North Carolina, so she's really the boots on the ground for the Carolinas projects that a lot of you are already invested in. So Lisa, please tell everyone a little bit about yourself, your history, and it's a really great story.
Okay, thanks so much, Sarah. You are so sweet. Yeah, this actually has been a really amazing partnership. We've been in some other partnerships that were not so amazing. So when you find that right partnership, it's, I've said this before, it's kind of like just finding the person that you want to be with for the rest of your life. It just feels right, and you just know that it's right. So it feels like we've done a lot more deals than 4. When you said 4, I'm like, no, it's been more than that. Seems like we've been working together for a long time. But anyway, so my husband and I, like Sarah said, we've been in the real estate industry a very long time, and we started out in residential in Arizona, and that was actually a really great career until the market crashed, and then we decided it was time to get into something different. And obviously it's a long story short, but we got into multifamily, and we started out with the same mentor that Tyler did, Dave Lindahl, in 07, and really realized the difference between, we were buying some single families, duplexes, triplexes, but, so much work for really not a big return. And just, you lose one tenant or 2 tenants and you're in huge trouble. So we actually started buying apartment complexes out in the Carolinas, which was just, a completely different market where you could actually still find cap rates that worked. You could still make money. And so we just started growing our portfolio. We moved our family across country, and we didn't think we were going to stay in North Carolina, but we love it out here so much. So, and then it turned out, the Carolinas, every time we'd go to a seminar, we'd meet thousands of people, and it was either Carolinas or Texas. If you're from Carolinas or Texas, everyone wants to talk to you, because those are the 2 markets. And this has been going, this is 12 years ago, and it hasn't stopped. So everyone kept asking me, why aren't you in Texas? Well, because I'm busy in the Carolinas. But, we have done a lot of deals in North Carolina. Then we started, branching out to South Carolina. And now we just want to diversify a little bit more. And Ryan and Tyler brought us this deal in Texas, and it just, sometimes things line up perfectly, and the timing was right, and we're ready to go into the market that we've always wanted to be in. So we're really excited about this deal and about, working with the dream team that we call ourselves. And that's so corny.
You're not supposed to tell people we say that behind closed doors, Lisa.
Yeah,
I thought that was in the circle of trust.
We are, though. We are the dream team. Sorry, Sarah. I think you're the one that made that up. She's probably embarrassed, but we are, though, because what's so amazing, and I'm just going to brag about all of us, is that everyone knows what they're supposed to do. We jump in, all right, we're in contract, here we go. And everyone knows what to do. We don't actually have to tell anybody what to do. We're hiring, more admin people so that we can focus on the important stuff, which is acquisitions, and it's amazing.
Great.
So anyway.
Thank you for that, Lisa. I agree. It's an awesome team to work with. And luckily, most of the people in the audience they know us, so they understand. And it's like, yeah, they're kind of family now. So awesome. Cool. So let's jump into the market. So was everyone able to click on the link to the property packet? Because if you want to follow along, it's starting around page 9 in the property packet. So the link is in the chat. Go ahead and click the link in the chat and you guys can follow along. Okay, so collectively, amongst our three companies together, we have about 3,000 units. So that's the size of our portfolio. And over the last year, most of the acquisitions, including some of the acquisitions I did with other partnerships, were in the Carolinas. And so you guys in the audience, you started to say, that's awesome. The properties are awesome. We'd like to diversify our portfolio. And so, Texas is the place that we started looking. And why is that? That's what we're going to talk about right now. So, how about I start with you, Lisa? So you don't currently own any properties in Texas, and so I'm wondering what makes you excited about expanding your portfolio into Texas and especially in Fort Worth.
Okay, well, I mean, I sort of touched on that a little bit already.
Yeah.
People have been telling me for so many years that we need to branch out to Texas, and I've been watching everyone around me invest there, but I still feel, confident about the Carolinas, but I see a lot of the same qualities in Texas that I see in the Carolinas. It's constantly people always saying, I'm moving to Texas or the Carolinas. People are moving out of, New York and California and, all these different places that this is even pre-pandemic, but especially since the pandemic, because they want the nicer weather and just, I don't know, people in the Carolinas and Texas kind of remind me of each other, just very, nice. And it's, visiting out in Texas for the first time when we went out to go see the property. The other day we were there for the second time. Just the same kind of feeling, just, you can see construction everywhere, growth happening everywhere, new businesses coming in, businesses that are existing, hopping, so busy. So it's just, I'm really excited. It just feels great. And Tyler obviously will speak a little bit more about the actual analytics of it, but I'm giving you more of the feeling of this area.
Yeah, awesome. Thank you. So Tyler, you lived in Texas, you lived in Austin, and you already own some properties there. So at a high level, what made you excited? Like, okay, I'm going to expand my portfolio. I'm choosing Texas, Fort Worth, like high level, since you know the space a bit better than us. What was that initial, like, I should go here because?
Mainly just because I want to be able to travel back to Texas and visit family and eat barbecue. I mean, that's the major analytics that Lisa's talking about. No, I love Texas for so many reasons, especially as an investment market. DFW is like one of the leaders. It really is the leader in the U.S. for employment and population growth. The population is projected to double over the next 15 years. It's the stat that I read, which is crazy. The growth has already been crazy as well, though. They're very, very welcoming to immigrants into the state as well, which is, aided in that population growth, aided in the tech growth, all those kind of things. Has a really favorable business climate. The Texas, renter or landlord owner laws are notoriously just very real estate friendly, to investors like us. One of the major things, though, as well that we look at, it's called a high rent to price ratio, and we look for a high rent to price ratio, right? So price to rent ratio, sorry. And just like to explain that, price to rent ratio means essentially measures the affordability of buying versus renting in a given market. A lower price to rent indicates a place that's more favorable to like home buyers. A higher ratio is better for renters, right? And we like to target markets that have ratios above 10. And Fort Worth, as an example, is 14.2. Dallas, if you break it down into those areas, Fort Worth is 14.2. I think Dallas was like 16. So that obviously bodes well. And then just renter demand, as housing prices continue to rise, even though cost of living is cheaper in Texas, which is one of the things we can chat about. Housing prices rise, which push people to being renters. And renter demand in Fort Worth is already one of the highest in the nation. It's like, I think it's like 52 or 53% of individuals in the DFW area rent. And if you compare that to nationally, that's like 33% nationally. So that's phenomenal for us.
Yeah, definitely good for people who are looking to buy apartments.
Well, who are looking, exactly. Yeah.
I want to address something that I see going on in the chat. Sorry, I didn't realize this, that the people can't view the property packet without a password to Juniper Square and all that. So sorry guys, if you can't see it all, you'll have to view it later then if you're having trouble signing in and taking a look at it. But I just wanted to answer that because I see a lot of people saying like, I can't view. So we'll take care of it after, so you can go through the property packet and then we'll just continue on. Okay, so for those of you who do, and you're able to view the property packet, we're around slide 9. There's a slide around the main economic influencers in Texas. And so I'd like to go through those and talk about one by one these economic influencers, how they affect our decision to buy apartments in that market. So you kind of touched on this already, Tyler, but let's talk about government. I mean, it's a big topic. There's a lot of changes going on nationally and locally. But what makes the government why does that affect our decision to buy apartments in the Fort Worth area?
Yeah. So, I mean, I'll say this as a quick brief, those 4 indicators, if you see them, is government, economy, tech, society. Those shifts have, changed the future, or have changed the past, and they'll change the future just like they changed the past, essentially, right? Which is why we keep such a close eye on those things when we choose a market. And Dallas, it's no surprise, it should be no surprise that the DFW area it performs well in all the areas. So government specifically, Texas ranks 9th in the nation for having a cooperative and responsive government. What that does is that eases location, expansion processes for businesses. They also rank, I think it's 4th in the nation for, I should have pulled the property packet up. So if I say 4th or 5th, is something wrong, you got to correct me. Okay, Sarah?
Okay.
But I think it's 4th in the nation for favorable, regulatory environment. So that's things like, no corporate income tax, or, and just predictable regulations. It just aid in that stat, right? Once again, just looking at, as companies are continually looking at how can we mitigate risk and how can we make sure that we, provide, an environment that we know we can grow in. They look for just predictability, and DFW, Texas as a whole just, provides that. So hope that answers that question.
Yeah, that does answer the question. There's a lot of people in the audience who are in California, and they're specifically moving their portion, of their portfolio that's allotted to real estate out of California into places like Texas for those reasons. All right, the next one is economy. So let's talk about, the business environment, employment opportunities. Number one, best state for business is some of the rankings that you pulled for Dallas or Fort Worth. So yeah,
you want to talk on that?
Yeah,
for sure. Texas. So the reason they're ranked number 1, Texas leads the nation in job creation over the last 10 years. And that job creation is kind of another bullet point to that. That job creation has led to them leading the nation in population growth for the last 14 years. That's job growth is a key indicator that we look at, because what happens with job growth is it brings people, population, household formations, which is a direct correlation to demand for our product, right? They have the 10th largest economy, which is home to, it's like 50 Fortune 500 headquarters. And COVID-19 has really only amplified that growth. As corporations are looking to mitigate risk, and every single pain point has become even just more brought to the surface, right? Of how can we alleviate these pain points? And one of those ways is to move to an area that, has lower, just more incentives, I guess is the best way to put that. More incentives, better regulations, which is why you see people flooding from, California, from the West Coast to Texas. The ocean is great. It's beautiful. Trust me, I'm looking at one right now. It's amazing. But as far as regulations for companies, yeah, no, Texas, Dallas, DFW area as a whole, it's very, very attractive.
Mm-hmm. Yeah. All right. The next one is technology. So Fort Worth, number 2 best tech city for IT jobs. So, I mean, there's all kind of 11% expected growth in the next year. Why is being a tech city, translate into a good place to buy apartments?
So we look at diversity of job growth, right? But one of the most important sectors that we look at is this information technology sector, and it's very broad too, right? But it's just an important sector that we look at, and the contributions that the DFW area has made to the tech economy it's impossible to overstate. DFW as a whole employs 43% of the entire state's tech professionals. I want you to think about that. You have Austin. Everyone knows Austin, right? It's a big tech city. Well, DFW employs 43% of the entire state's tech, professionals, which is crazy. And once again, that's only amplified over, the last year with the coronavirus and people just flooding to Texas as a whole and DFW because it has what people look at and corporations look at, incentives certainly, but they also look at transportation and just the infrastructure of a city and how it can support that growth if they decide to expand there, which is, one of the things that we put on there is, just the ability to expand is, it's once again, it feeds all of those things. So tech in DFW area it can't be overstated. It's crazy.
Yeah, let's talk about the transportation one because I think that's interesting. It's not normally something that's on like the checklist of what to look at in a market, but in the DFW market, because it's growing so big, infrastructure is really important. So you want to expand on what you just said about transportation, infrastructure, what you're seeing in the area and how that influences decision to buy apartments.
Yeah, I mean, you have DFW Airport. It's a huge airport. American Airlines, number 1 hub. You have Dallas Love Field. That's Southwest Airlines, number 1 hub. Southwest is the largest low-cost airline, but they're also the 4th largest airline overall anyway. You have Alliance Airport. I guarantee you that I don't know how many of you remember, but I guess it was like a couple months ago when Dallas area freezed up. There's a big freeze in the Dallas area. I was actually caught out in that. I was actually in Dallas when that happened. Had to sleep in my car for a couple of days. Rough. But I'll tell you what I guarantee you've noticed is that your Amazon packages were a little bit late. That's because in DFW, there's an airport called the Alliance Airport. And it's like the number 1, they call it a high capacity industrial airport. I think is what they call that. But I want you to think of FedEx, UPS, all these shipping companies, right? That's where their planes, take off from, is that airport. So transportation, once again, as these companies move in, they still want to be able to reach globally, nationally. And from Dallas, you're a central location in the nation, and you're a couple hours from really anywhere you want to go. And, living in Austin, I can attest to that. My flights, whenever I'd fly anywhere from Austin, was a lot easier than it is from Maui now. Or I lived in DC before that, so on a coast, which just makes it more difficult. Living centrally and having the infrastructure of those airports, game changer for transportation, for companies, individuals, all the above.
Yeah, awesome. It's super important if something is growing that fast that that it can handle it.
Yeah.
All right. So for those of you who are asking, yes, all these, if you look in the property packet, it does state where like the citations of the data is just under the, if we have a data point, the citation is under it. So you can double check it. So cool. So for those of you who asked, the page number we're on, kind of feel like I'm in church. Flip to page 35. And we're going to talk about some of the statistics, some other very specific statistics about Texas. Okay. And then what they mean, what they translate to when you're talking about investing in that market. So we kind of hit on it before, but 8% below the average U.S. cost of living. So that's for Texas overall. So if the cost of living is low, why does that make it an attractive place to buy property?
So, and I can answer that one too. And I'll say, and we covered government, economic, tech, and this falls right underneath society, by the way, societal shifts, right? Cost of living is important. And that is, once again, only escalated, over the past year with the pandemic, where people now are working remotely. They want to work places where they can live that are warmer, and that they can live for less. And a big important portion of that is because of that cost of living being lower, more young people are flooding to the area, and those young people are prime renters for us. Prime renters. They also aid in just a strong workforce, which is another thing that companies look at when they go to relocate in an area or expand in an area. Is there the job force, the potential employees to be able to, what's the word I'm looking for? Facilitate, encourage, fill those roles, right? Listen, It's 6:30. Coffee will kick in and vocabulary will kick up. Okay.
And that also
aids in that.
And like leading to the same reason. So in Texas, there's 170 colleges and universities. And so why that's good is the same reason you just said, right? It produces like all these people who are looking for jobs. They're fresh, they're hungry, they're smart. And so that also is why it's attractive for businesses to come there and build their jobs where the fresh students are, right?
Yeah, you have, no, exactly. You nailed it for sure.
Yeah, awesome. Okay. I think you already touched on this, but I was going to go over on the next page. There's some stats about Fort Worth and population. So it's the 13th largest city in the US, almost 1 million people. And so I do have a question. So as it's expanding, as it's growing, it's projected to grow insanely over the next decade. And like you said, Lisa, there's a ton of construction going on. When you were there, you saw a lot of new builds. So I'm curious what you're seeing as far as supply and demand. Do those seem to be going at the same pace? Does it seem like one is going faster than the other? Some markets overbuild because they are like, yeah, it's going to be a bang up market. And then there's too much supply. Sometimes they don't build fast enough. So what do you see in the region as far as that supply and demand balance? Because it's growth in both of those are really going crazy right now.
Lisa, I'll let you were just there, talk about, if you don't mind, talking about just the comparable properties on the street and their, vacancy,
right.
Occupancy, what's there? Yeah.
Yep. So I can speak about, what I actually, I'm more, rather than, going through analytics, I'll actually go through and physically walk the competition as a prospective tenant, go in to see not only what kind of upgrades that those other complexes are doing, what kind of customer service they have, and then, in our own way, try to get the actual information. If you call up as someone that's trying to do a comparable market analysis, you don't get the same information as you do when you actually walk in and pretend like you're trying to rent something. So we did that on all of this summit is actually on a street with several other complexes. So what we found when we went to every complex that's on the street is that there's 4 complexes on one side of the complex that are all a little bit nicer than Summit, but not really location or anything that couldn't be solved. It's more just Summit has been neglected as far as management is concerned. So when you go down the street, there's a complex that's a little bit nicer, then the next one over is a little bit nicer than that, a little bit nicer than that, and then the one at the end is really nice. When I went into that one at the end, that's when I got really excited because, it's a B+ property. I would live there. and it's only 4 complexes down. So we would be able to, with some good marketing, and what Summit really needs is some curb appeal. We need some good signage and curb appeal to get people to come to us. And all we need to do is be a little bit less expensive than those other alternatives, and we will be able to keep our occupancy very high and be able to push rents quite a bit, because the current seller is just neglecting everything. You pull in, it's dead bushes and no real signage. The paint is faded, so people will just drive by and they'll go to those nicer complexes. So that was pretty exciting to know that there are obviously people in the area that can afford those complexes. But the other exciting thing is that we were being told that there was no apartment for us that we could rent for months. So these places were full, and we're talking at least a couple of months before we'd even be able to get an apartment. And that's at the more expensive complexes. So we were very excited about that.
Yeah, that's the key. That's the key piece, like, is the rent higher and they're nicer? Okay. Oh, and they're full and there's a wait list. Okay. That tells us supply and demand, that the demand is still higher than the supply right now.
And we also went and saw actually what their product was, to realize that their product's not, they weren't doing granite countertops or anything extravagant. They're doing exactly what we're planning on doing. But like I said, we can come in just a little bit less expensive than them, being a little bit less of a better alternative for someone who just wants to pay a little bit less. I mean, $20 less will get people to come to our complex, but we still have a lot of room to push.
Mm-hmm. Yeah. Okay.
I'll mention one more thing on that, if you don't mind. We talked about societal shifts, and one of the societal shifts, there's this book called Big Shifts Ahead, a guy named John Burns. He's just a genius when it comes to market stats and indicators and stuff like that. And it's projected that 62% of household growth over the next 5 years will happen in the southern regions, which is why you'll see that we're so focused on the southern regions. 24% of that growth is projected to happen in like the southeast regions, which, the Carolinas, but that's like Louisiana, Alabama, Georgia, all the Carolinas, Tennessee, that whole area, right? The next closest to that of any other region is Texas, which is a state. It's one of the only regions that is a state that they consider a region, a region that is just a state, right? And that's 15%. So 15% of that, of the household growth over the next 5 years in the entire nation, 15% of that's a big stat, is projected to happen in Texas. And that's due to warmth. People love warmth, but also affordability. We talked about cost of living, 8% below national average. It's a beautiful thing. South Carolina, North Carolina, or South Carolina, which a lot of you are investors on, that's 12% below cost of living. And you can see how well those assets are doing there. Cost of living is a big aspect for the growth. It's also, just a pro-growth environment, just meaning the infrastructure, government support the growth. And Dallas, DFW area, obviously, fits into that realm. So.
Yeah. And I like that you're looking at household growth. So there's a data point around population and economic growth and rent growth. And these are all important things to look at, but also household growth, I would say, is an even more important indicator than population growth, because you could have, actually 2 households become 1 household and have a bunch of babies. So your population has grown, but your household has decreased. Yeah. So taking a look at how many individual households and how that increases, that's really the more important. And they're both important, but I think that the actual household growth is even more important if you're thinking about purchasing apartments.
Totally. No, household formations. I mean, exactly like you just said, population is an important stat, but like you said, it's, somebody could have a baby. That doesn't necessarily increase the demand for our product, right? But household formations, that's households that are forming. So, on the other side of that, it could be 2, buddies that live together who can now afford to live separately. But it's households that are forming, which is in direct correlation to demand for our product. And, the the base qualifier that we look for in a market is over 2%. And DFW area surpasses that. I think it was like 2.2 or 2.5% household formation, which is very, very good for sure.
Yeah, definitely. And that ties in with the median age being around 32 years old. So the household growth is not in seniors or, folks that have teenagers at home. Well, I guess some of them could have had teenagers, but it's the household growth and the median age being 32 tells us that it's the exact demographic of households that we would like for apartments.
Totally. So here's another stat, okay? 6.5 million households are projected to form by 2025. So really over the next 4 years.
It's a lot.
Over 3 million of that will be formed by millennials. And, millennials, we're talking, born between 1989, 1994, right around there. They represent the largest 5-year age group in the country. I think they're like 28 to 33 years old now. And once again, median age is 32 years old in the DFW area. So once again, it just bodes well for that, not just household growth, but the household from the growth that we're looking for, the demographic that we're looking for, which is our just prime renter age. So,
yeah, exactly. Another stat. So this is on page 37 now, you guys. Average income of 65,000. So why is this significant? Because sometimes I have people look at that indicator, if we put it in a property packet, and they're like, I'm not sure exactly why that tells me it's a good or bad thing if the average income is 65K. So you want to expand on that one?
Yeah, you want me to take it?
Yeah, please.
Yeah, so, one of the things that it mentions in the property packet, I'm pretty sure, is the increase that's happened over the last 10 years, which, I think, correct me if I'm wrong, I think it's 40% increase over the last 10 years.
Good memory, 43%.
There we go, 43% over the last 10 years. And the reason that's important, you look at, once again, cost of living, but also job growth, and how does that relate into pay? Somebody had mentioned, I think I saw somebody said, no personal state income tax as well. I think Jerry said that. And it's exactly right. So it's threefold, right? Cost of living, important. Salary above national average. And I cannot remember national average off the top of my head right now. I think it's somewhere in the low 50s. But so it's above national average. And then also you have the incentives, the tax incentives to allow them to actually keep that. And you have the job growth. So those tech jobs coming in, I told you, was one of the biggest indicators that we look at. And the reason that we do that is because those are high paying, good quality jobs that attract people to come into a market because they're high paying, good quality jobs, right? I hope that answers that question.
Yeah, thank you.
But then also that means that people can come in and pay the higher rents that we are going to be, we're going to be doing premium units and raising rents, and we want to be able to obviously have people that can afford those higher rents.
Yeah, nailed that one. I don't know how that's a great point. I totally missed that one. That's the most important thing.
Yeah.
All right, cool.
I'm just here to say duh, Tyler.
It's almost going to be your time to talk about the specific property. I want to hit on one last thing before we start talking about the property. So I want to talk about employers. So we talked about jobs, job growth, stats around it, and why that's important to look at. And we talked a bit about American Airlines. We also talked about how important it is to look at purchasing apartments in a market where there's a diversification of employers and diversification of job types. And most people know that it's just like booming job-wise in the Fort Worth area. But I wanted to give some stats. So American Airlines employed almost 100,000 full-time workers. They're putting in a new $1 billion headquarters, and it drove up employment like 3% last year during the coronavirus pandemic. So some people say, well, is it slowing down in the DFW area? Well, if you look at the stats, and there's more in the property packet, like listing out who the employers are and how many jobs they are sending there, and the job growth, it is still going gangbusters there. So like I already said, American Airlines, there's Lockheed Martin, General Motors, Lone Star, Bell Helicopter. They're all these like big companies who are there. Do you have anything else you want to add to like what type of employers are in the area, Tyler?
The only thing that I'll add to that is just diversity of employers, because it's one of the things that makes me so excited about branching into the DFW market, or growing, I guess, in the DFW market, is the diversity of job growth is important, because when you have one sector, for an example, right? Let's say that it was just American Airlines and that was the, number one top employer, and everything else was in, a different sector, or everything was in airlines, or everything was in, oil. You look at, a lot of people look at Texas and Dallas and Houston, they think of just oil, right? So oil and gas. We want diversity, because if one of those markets gets affected, then it wipes out everything. But when you have diversity of that job growth, which meant the DFW area has done an amazing job at not just attracting jobs, corporations, but the diversity of those corporations. In my opinion, it's one of the most important factors there.
Yeah, it makes it super attractive for sure. And that's so my last question on the market is going to be like, did I miss anything? What's most exciting to you? And for me, what's most exciting about the market is the job growth, the diversity. Like there's no signs of companies moving out of Texas or out of the area. It's companies moving out of crazy places like California, going there. And the infrastructure is growing to support that. And so I'm excited about being part of that growth. Is there anything else before we dive into the property that you want to hit on, Tyler or Lisa?
I think I'm good.
Okay.
Yeah, I'm good. Property.
All right, cool. So I'm going to jump in and talk about the property. I see you guys have a bunch of questions on it. So I'll just give a really high level of the property. So it's 224 units. The management team, or those of us on the call, the minimum investment is $100,000. It's for accredited investors only. It's a 506C. And we're currently doing due diligence, and funds are due May 7th. So that's in about 1 month. So in the link that I put in the chat, you can sign up for an account. You can put in a soft reserve, and you can view the property packet and all the details that we're going to chat about for the remaining 15 minutes. And feel free to reach out to me with any questions you have after reviewing anything. And what else? The returns, there's 2 tranches. So 7% is the preferred return for an investment of $100,000. If you invest $250,000 or more, then there'll be an 8% preferred return for you. And the annualized returns are sitting around 18% on a 3-year hold. And I see a lot of questions about why 3-year. We're getting a bridge loan for the property. And I'll let Lisa expand about on this in a little bit, but we think that we can turn around the property in that amount of time and get you that balloon check at the end sooner than 5 years. So that's why we're going to do it that way. All right, Lisa, since you were just there, I see a lot of questions. Why don't you start with a bit of the story? So like, why is the seller selling this property and why right now? And then, they already did some remodels, but they left some undone. So talk about, the story of the value add that you're planning to do.
Okay. Well, this seller is selling just because he held on to it for the amount of time that he was expecting to hold on to it to give his investors his return. He's not a very impressive seller or owner. He does actually what we typically look for in properties is owners that just like to slide by and stay, relatively full. He's kept a good occupancy, but at very, minimal effort and minimal investment as well. So he, did some upgrades and was able to push rents $100 but his upgrades, even his upgrades, are really not all that impressive. So it's interesting how, you know, we see the exact same pattern over and over and over, and those are the properties that we've always done the best at. When we can take over a property that, you know, there's definitely high demand for it, it's in a good area, and the owners just don't want to put that little bit of extra effort and money into getting it to the next level. And I think what they want to do is just, you know, sell it with the meat on the bone for, you know, the next buyer. And our plan is to come in and take the rest of the units and make the units premium, which would, you know, and this is in the property package, which would include new flooring and new appliances. You know, we refurbish the countertops, or, you know, do a resurface on the countertops. We'll resurface or refurbish the front of the cabinets, put on doorknobs. It changes. I mean, it makes it look so amazing without actually having to put in new cabinets or new countertops. And, you know, fresh, modern, you know, gray paint. And people just absolutely love it. And this is what we've been doing in the Carolinas for years. And it's amazing, you know, $100 is not that big of a push from our experience. We may say that we're going to push them 100, but we're always trying to push them, you know, as high as we possibly can that the market will support. So we'll go in and we'll experiment with, you know, what people can afford and what people are willing to pay. But the first thing that we like to do before we start putting money into the interiors, the first thing that we like to do is we want to come in and we want to rebrand. We'll put up a big banner that says new ownership, new management, make it, you know, give it a new name, and put a bunch, you know, do some beautification on the front, change the curb appeal. And what that does, because this is actually going to get a lot of drive-by traffic, what that does is it gets the whole community talking about it. Gets the whole community saying, "Oh, did you hear that place changed?" And so even if they have been there before, or if they haven't, they're going to want to come in and see what we're doing. They're going to want to come in and see what's going on at that complex. That's when we will get them to come in to see our premium units and see how beautiful they are. But if the curb appeal doesn't look good, and it doesn't matter what you do on the interiors, nobody actually wants to come in to see it.
Yeah, awesome. And I like, I kind of see this as easy. Well, it's easy for me to say because I won't be doing the work, but easy in that it's already like a proof of concept, or kind of like a pilot's already been executed. They already did partial. And so it's like continuing. So it's not a big guess of like, can it be done or not be done? Will it be worth it? It's like, it's already proven.
Yeah, and that's a really good point, because there are sometimes we go into a market and we just kind of hope that it's going to work. And we've always been able to make it work, but it's definitely true, especially in seeing the nearby neighbors, because the nicer complexes are doing the same thing and they're getting quite a bit more, definitely a lot more than $100. And you know, the really nice complex I was talking about, they did an amazing job with front curb appeal. When you drive by, you go, "Wow, that's a really awesome complex." When you pull in and you go into the office, they've got these really high ceilings, and it's just, there's a really awesome, leasing person that comes up to you, and they just make you feel like you're in the nicest complex ever. But when they went to take us inside to see the interiors, I was excited because they had white appliances, just did the spray over, just did the resurfacing. It wasn't granite countertops and stainless steel appliances or anything all that amazing. They just got people in with their curb appeals, like I talked about, and getting people to come in and say, this is the place to be, and they're making that their complex. This is the place to be, and people will pay more for that.
Yeah, awesome. Yeah, I think it's an easy business plan to carry out. So, are you guys ready to dive into questions?
Sure.
Okay, cool. We've got a bunch. I think some of them we already covered, but I'm going to pop over to the Q&A. So you guys, if you have questions, put them in the Q&A. I think a lot of them we already answered about hold period, 3 years. Current occupancy at the property. Is it at 96%, Lisa?
I think it's 94%.
94%? Okay.
Yeah, we ended up actually walking through all of the vacancies, and even most of the vacancies were 98% completed. So by the time we take over, it might even be higher than that. So like I said, they're doing a great job at keeping occupancy up, but that's, some owners, that's their goal, is let's just keep occupancy up, not necessarily, maximizing the income.
Mm-hmm. All right. Questions around the property manager. So I think this is a pretty exciting aspect of this project as well. It'll be a new property manager for us to work with. They use AI in how they manage their properties, and it is very high tech, and thus it makes the cost of the property manager much less than it usually is. So when Ryan did the underwriting, he underwrote here's the normal cost for a property management company in the area. So that's what the underwriting addresses. However, the company that we're going to be using, it's going to be a much lower cost. But we underwrote it at kind of a normal cost. So in case, it's a brand new company. So in my mind, if we have to shift into a traditional property management company, we know that the returns are still where we want them to be. But they do everything as virtual as they can. They have a really cool stat. So they have 5,000 units under management right now. And they had a cool stat of, especially during COVID, the time that someone could find them on a phone to actually moving into the apartment was 24 to 36 hours. Because it didn't depend on, let me go and get a property manager to, get out of the leasing office and show it to me. And then we do a paper application. It was they could do a virtual tour on their phone. And then if they liked it, they could go over it. They got a code. They could go over at 2 a.m. to the property, punch in the code to a door, because they got a code that was only valid for their half-hour time slot. They could go view the property and then go back to their app and say, now it's 2:30 a.m. I like the property. They could do the application online, and the application is audited not by a human getting to a pile of paper on their desk. And then, approved, checked out, background check, everything. And then, keys to it was just I was so impressed that whole process could take 24 to 36 hours, a pop-up out on a phone to someone moving in, because that's how streamlined their process is. And so I think that's so key in this market. Like Lisa said, she went and toured the properties, and they took the time to tour the property with her. And then they said, we'll put you on a wait list for months from now when we might have something. And so if we can capitalize on this and just say we got something and get people in quickly at the higher rates, it's going to be really smooth. It's really going to help make things really efficient.
Even more so, those lines, we'll be able to capture more of the market, more of the residents. And when we can create our own waiting list, then, as we're pushing rents up, and we have, we always, when you push rents up, it's ultimately you're going to lose some residents. That's just part of the game. So as you're losing residents, if you've got a waiting list, then we can continue to be aggressively pushing rents without worrying about it, because we're always going to be capturing as many of the leads in the market that we possibly can. And like you said, with the convenience, most of the younger people, and since this is a younger area, they really love to be able to just do everything from their phone. People like to do things on a whim. They don't want to have to wait for callbacks and all that. So we will still have a manager or a leasing person on site, so that we have that face-to-face and that we have that rapport that we build with the residents. But, I've had complexes this size where we have 2 or 3 people in the office, typically 2 people in the office. And when you have more than one person in an office, it's especially 2 women, they're just not all that productive, because they're, getting in each other's way. I see a lot of, just with the management company that we have now, a lot of times you just have unnecessary reporting and wasted time. And this is a really great way to be able to actually streamline everything.
Yeah, I think it's super cool, Ryan. So people asking, what's the company name? It's Simplify with 2 Y's. And Ryan, one of our other partners, started talking to me about this company like last summer. And, you know, being here in Silicon Valley, I was instantly like, AI for property management sounds awesome. So I'm excited to get to use them on something.
Well, and I'll say this to you: you look at the tenant base that we're tracking. It's the low 30s, type tenant base, which that's exactly how they are. They want, and you know what? The beautiful part about it is we can appeal to both sides, right? If somebody wants the personal one-on-one touch, we can provide that. We have that, right? But we can also provide, more importantly, when someone, I'm telling you right now, I don't want to go and talk to somebody. I want to go, I want to tour, I want to see, and I want to make the decision. Time is important. Time is important. I'm very, a lot of us are very cognizant of that. And so being able to make that happen quickly is good.
Mm-hmm. Right. And Sarah, you said that when Ryan told you about this, you were right away excited. Well, being in property management for so long, I was not excited. I was actually very skeptical. And so I told Ryan, I want to actually talk to the CEO of the company. I want to actually talk to, who's the one that created this, and they're going to need to break this down to me. So, because I'm from old school, people in the office and all that other stuff. But at the same time, I'm also very technology savvy, and I really like to be able to do things quickly. Like Tyler said, time's important. And I love the idea of being able to streamline things. But we actually sat down the other night with the CEO. I actually sat right across from him at dinner and just hammered him with questions. And, they definitely have the right answers, and they definitely have thought of everything that I could think of. So, I'm actually really excited about it. I think that they're, beyond their times, and this is definitely the way that things are going. Especially, COVID has made us see that being able to do things with, artificial intelligence is definitely the way of the future.
Yeah, awesome. Thank you for that. I see some other questions around kind of CapEx and the CapEx breakdown. Like, is there any big heavy lifting? So I'll let you take that one, Lisa.
Hey, can I mention one more thing too? Because Lisa had mentioned, I just real quickly, as we start raising rents, we'll lose tenants, and we've accounted for all that in our underwriting. Right now the property, I think is like 94%, and Lisa may know differently because she just barely walked it, but the last rent roll that I looked at, 94%, and our vacancy that we account for with our underwriting is 10% vacancy. So we always leave these buffers, and these buffers within there. Also, I saw one more question, if you don't mind, about rent projections, and with the upgraded units, what can we get it to? Our rent projections in, the property, all the numbers that you'll see, those forward-facing numbers that you'll see, range anywhere from just depending on the unit size, $50 to $100. But we can definitely exceed that. Those are very, very, very conservative numbers. But all the projections that we, submit on the forward-facing material to y'all are conservative numbers, and then we have aggressive numbers that we attack on the back end. Sorry, Lisa, go ahead. I'll let you take it from there.
Okay, and then, I just actually texted Greg. He said there was 14 vacancies, so we're somewhere around 95%.
Cool, awesome. So the question around CapEx, is there anything big? Looking in the property package, doesn't list, this was put together before you were there, so it doesn't list anything like big and major, like a pool, but you want to answer that one?
No, there really isn't anything, big. This is, beautification. I think, painting the exterior, or maybe possibly we're talking about vinyl siding some of the exterior, just to give it a really good look on the outside. Rebranding and interior upgrades is the biggest thing, maybe adding some amenities. But no, it's always a little scary when you go to do the inspection, because I have had inspection days where by, the end of that first day, you're wondering, should we even move forward? So it was exciting. We, after a couple of days going through, inspectors would come in and would say, "Find anything?" And we're always kind of holding our breath. And they're like, "No, just the same old stuff that you see, some deferred maintenance and things that we definitely expect." So very, very, very cool that we were able to get through, 4 days of inspections with no big surprises.
Yeah, that is really awesome. Really awesome. So going through the questions some more, I see someone asking about the returns. They said 7 to 8% annualized return does not equal 18% over 3 years. So let me kind of say how the returns work. So there's a cash flow. So like the 7 to 8% is meaning over those 3 years, every quarter there's a check that you get. And so that equates to about 7 or 8% per year, but it's broken down, divided by 4, and that's paid every quarter. And then when we sell the property, it's going to sell for a much higher price based on the value add plan that Lisa is going to execute. And so then when we sell it at the back end, at the sale, then you get a big check at the end. And so if you take the cash flow that you've received over 3 years and the appreciation check at the end, and you say, okay, collectively, how much was this over 3 years? It would come to 18% per year. So I hope that clarifies that, how that calculation is. There's a question, why did distributions start third quarter after close? Tyler, do you want to take that one?
Yeah, it just gives us time to put the business plan in place. So, investors always want distributions right away, and we have reserves and the ability to do all those things. But the most important thing is to not only provide returns, but to protect your capital. And so we're very cognizant of that. So as we go in, we like to get a couple quarters underneath our belt, make sure stack reserves, see if there's anything that comes up that wasn't according to plan. And there's always going to be something that comes up that wasn't according to plan. That's just what happens on these properties. And so that's what we do. We make sure that we have a little bit of track record, build reserves, and before we just start, distributing willy-nilly, that we distribute, calculated, and make sure that everything's good to go. So one of the biggest risks that, with these properties is just as you go in and you implement a business plan, one of the biggest risks are what happens as you implement the business plan, right? Like Lisa said, and some tenants moving out and changing the community, we have to do some evictions. Like when you come into an area that's had a bad owner, you're going to have to do some evictions. One of the biggest risks on the property, well, there's an eviction moratorium. We can't go through the legal, the court processes to evict tenants. There's plenty of ways to evict tenants. In fact, our other property just up the road from here, we bought in 2020, right in the beginning of 2020, and we've been able to evict a whole bunch of tenants during that entire time, because we get creative. We never focus on uncontrollables, we focus on controllables. And I'll tell you, one of the strengths that we have as a partnership is being able to understand the needs of others. And if you go in, a lot of people just go in or try to present options to individuals that they need to evict without just asking the questions. And we train on those questions and how to ask. I'm not the one going in and asking those questions, but we train our team to be able to go in and do those exact same things and then offer solutions that are relevant to their needs, which is how we're able to do those things. So I don't know how I got off on that tangent, but I think that was a question.
Yeah, that was a question. There actually a lot of people are asking that, like, what's the biggest risk? What's the 3 biggest risks for the property, and how would you mitigate them? How do you think COVID will affect this and evictions? So you just answered like 6 questions that I'm looking at right now.
Love it. Yeah. The eviction moratorium is a risk, and how do we mitigate that as operational strategies, which is why a property like Summit, I'm going to tell you right now that this is like our bread and butter, because it's operational deficiencies that we're able to come in and put operational strategies in place. One of the things that we do to mitigate those kind of things, to mitigate turnover, to plan and prepare, happens before right as we take the property over. As we take the property over, which is the takeover process of any property is just important, but especially a property where you're looking to build the community. We look at it in a couple phases, and that first phase is going in and building relationships with the tenants, establishing relationships, removing any concerns, figuring out what, maintenance requests haven't been taken care of. The number one reason people move out is not handling maintenance requests. So what we do is to mitigate that, we go in and we get a note of all outstanding maintenance requests. And then we get a schedule and plan in place to be able to handle that for those tenants. Once again, it's listening to people. It's understanding what they need. And that's critical because, as you take over property, we have projections, we have understandings of what we're going to go into, but we also, as we take over property, we have to be able to understand what the tenant needs are. And the first thing that we do is literally have our team call every single tenant right out the gate to let them know new ownership is taken over. We call everyone we contact any tenant that has a lease expiring within the next 90 days. We get their pulse on if they're renewing. We give them some incentives as far as, a lighting upgrade or, something interior upgrade to be able to, incentivize them to release. And then it just gives us a pulse, and we continue to do that. Actually, we continue to contact tenants with expiring leases, in the next 90 days. We do that through the entirety of the hold period, which allows us to plan and prepare for turnover. So say that somebody says that they're going to move out. Well, we've already accounted for that within our budgets, within our CapEx. And honestly, we need some people to move out. So as we go in and we up the rents and they don't want to renew, well, we've planned for that. We've prepared for that. Now we go in, we take the CapEx budgets that we have, and we go in to increase the quality of the interior of that product to bring in a new tenant. But going in at the 90-day mark allows us to prepare for all of that. We can get it pre-leased within 90 days. We can plan for what needs to happen. That way, the day that they move out, our team is in. We know exactly what needs to happen, and we can get a tenant in as quickly as possible. Every single day that a unit goes unoccupied, vacant, right? It's rent that we never get back. And so that turnover is a big way that we can mitigate risk in getting new tenants in.
Yeah, I love it. There are a lot of questions about explaining the exit strategy and the risks around that. Or like risks that we might foresee. So like what happens in 3 years if we're looking to sell and the market's not where we want it to be, there's a softening in the market. Do we see that kind of risk? So questions around the risk at exit if there's like a huge crash in the economy. What have we built into our business plan in order to mitigate that?
One of the questions that I saw on there, and Lisa, I can let you answer that too, but one of the questions I saw on there was the risk of interest rates rising. And that is a risk, and we project the interest rates will rise. On most of our other properties, we put in long-term debt pieces at the lowest interest rate we can, and maybe we have somebody assume that down the road because we're projecting interest rates will go up. But that being said, this is a 2 to 3 year hold is the plan. And it's a lot harder to project out for 5-7 years. In fact, it's very, very hard to get any pulse past 5 years, right? But a 2 to 3 year pulse, when you look at interest rates rising, you look at historically, we're at very, very, very low interest rates, very low. So, and we do project the interest rates will rise, but it's not going to rise all of a sudden to 10%, 6%, which would just dramatically, impact your cap rate, your exit cap. We do a pretty conservative exit cap as well, but your exit cap isn't going to be, affected by, a few hundred basis points. It is going to affect it, but not into anything that is astronomical. But that is also been already, accounted for within our exit projections and everything we have there as well. Was that the initial question? Sorry, I had read a question that I took off on that.
Yeah, I think so. How about all of you who asked questions about the risk at the exit and those kind of things? Let us know if that answered your question or if you still have a question around that.
I also wanted to just add to that, to what Tyler just said. I hope you can hear me okay. I'm kind of going through some mountains, I think.
Mm-hmm.
We've had multifamily properties through all different market cycles. We bought our first complex in '09. So going through, 9, 10, 11, and even 12, it was a really tough market. The key is great operations. If you know how to operate your property and keep it well occupied, offering the best product at the right price, it mitigates a lot of the risk, because we don't want to sell because we have to sell. We want to sell because it's the right time to sell. So in 2 to 3 years, if we're in a situation where it's not the right time to sell, we would be able to offer, options, and we can, like Tyler said, rates will probably be a little bit higher, but chances are they're not going to be higher than they were over the, few years ago, and the deal will still work. So, they're not going to go up to 10% or anything like that. So we'll be able to refinance as long as our operations are good, and we know what we're doing at the property. The lenders are going to be interested in refinancing us. So, we know how to mitigate the risk. We've already been through the worst.
Yeah, I appreciate that. And that's one of the awesome things about working with someone who's been doing this for more than 3 or 5 years is that, members of this team have been through this situation several times over. So they know how to handle things like that.
Yeah. Can I
there
tell
were
you
times
something?
where we were 7%. We had a loan at 7% at one time. So.
Yeah. Going through and, getting scars in the investment world, it's what makes us so valuable as a partnership. Because if you find somebody that doesn't have any scars, meaning they haven't made any mistakes, haven't had any problems through, that's a huge worry to me. Because like your mistakes, those are the things that you learn from the most. And man, the last crash, I was getting clobbered in the downturn, and I didn't look at that as a blessing at that point, but it was an absolute blessing, because I learned so much to build a stronger foundation moving forward. And, one of the approaches that we take is you have all these people out here, all these multifamily owners out here who are asking for forbearance, right? Forbearance means essentially leniency, right? Just like how there's tenants who will ask to, have payment programs. Well, there's owners who will ask the lender for forbearance to be able to give them some slack for the next little bit. We don't do that. We do the opposite of that. In fact, what we do is we call our lenders and the relationships that we've built with them and the track record that we have with them, that's strategic. And that's been handled. It's been handled strategically throughout every single ounce of time that I've been in the multifamily space, is because I was learned to treat those relationships just like investor relationships, as they're sacred. And so I'll tell you, when I started hearing about people, asking for forbearance, it's not what I did. I called the lender and said, hey, I'm not going to ask for forbearance. We pay our bills. We have solid operations in place. So I want you to remember that when people start to foreclose on these properties, I want you to bring them to me, because I paid my bill, right? I pay the mortgage. And just that communication alone continues to build that relationship, right? So it's your relationships. This is a relationship-based business with investors like you and lenders on the other side and brokers as well. That's how we're able to do these deals and operate these deals. And I have one more thing, if you don't mind, Sarah, because I saw that Jeannie asked a question. Jeannie, it's so good to see you on here, by the way. And she talked about due diligence and hard money, and how much money, hard money did you put down, and how does that, affect your ability to get comprehensive due diligence items. We put $400,000 of hard money down, and that is a large chunk of hard money. And I'll tell you how we do this. Okay, that's negotiated at the LOI process, and then we negotiate the PSA. And the reason that it took us how long? I mean, it's been a few weeks since we won the deal with the LOI, and it's been a few weeks that we've now been negotiating PSA and just finally finalized that and have brought it to you. And the reason is because we negotiate hard from LOI to PSA to make sure, Jeannie, that we have all of those things. So we get the terms that we need through the LOI. We negotiate hard with everything that we need to the PSA, because that's when we, submit earnest money, is once we, finalize the PSA. But we need to have all of those things within there, and our ability to get in there, and clauses within the PSA if something is not, given to help with all that. So once again, that's a learning lesson that we've learned in the past, in my early days. And, Lisa has learned that as well, I think, because she's very cognizant of that as well, to negotiate all those things up front to make sure we get them. So.
Man, I would not want to be on the opposite side of negotiating with Lisa.
I don't know what that's supposed to mean, but
it means you're an ass kicker, Lisa. I hope I can say ass on this. So I don't know if I can say ass, but
my husband is sitting here right now. My husband is sitting here right now. I think he agrees with you.
Yeah, no, I mean, I want to be on your side on the negotiation table for sure. Broderick, I see your comment. People matter, relationships matter. Like your approach on calling the lenders early. Yeah, I think it's awesome. I didn't even know you did that, Tyler, and that's totally awesome. Hey, I'm paying. If someone's not paying, bring me their property. I'll take it.
Absolutely.
Very smart. All right. So we still have a ton of questions. I do want to say, guys, we figured out what was going on with the portal. So now I put the link in the chat. You can click, you can view everything now. It was just a setting that had been checked. So I put the link in the chat. Go ahead and click there. You can view the property packet. You can view our track record, the business plan. You can view everything now. And then if you like what you see, there's a thing that says, hey, click here to do a soft reserve. So the whole raise for this is 8.8 million. And I think we're a little shy of 8 right now. So, but that's just soft reserve. So there's still room. So go ahead and go in there, click place a soft reserve. And then some people were saying they didn't hear anything after that. So go ahead and check spam, because after that, you should get an email from the system, from Juniper Square. So it'll be an email that says, here's your private data room. And then we'll let you know next steps, probably on the 23rd. If not sooner, is when our subscription documents will be ready with the PPM and everything. So I'm meeting with the SEC attorney to get that all put together as fast as possible for you guys, so that so when it's ready, you'll get an email from the portal and from me saying, okay, next steps are ready. You can go in, review the paperwork, sign the paperwork. Then, since it's a 506C, we're going to use Verify Investor. Only accredited investors are able to participate in this opportunity. So there's this added step where a third party is going to verify that you're an accredited investor. We pay for it, so there's no cost to you, but it is a requirement that we do this. And so then after you're verified, then you can go ahead and wire the funds. So that'll be the next steps, and looking to complete that whole flow by the 7th of May. So we have about a month to do that. So for those of you who said, I put in a soft reserve, am I okay? Yes, you're okay. We've got you in there. And then you'll see a message from us when you're ready for next steps. Okay. Let's see. Do you guys have some time for more questions, Tyler and Lisa?
Yep. Yeah, we're just trying to go to a property tour. So, yep.
Okay, very cool. All right. So we have a question from Mark, our favorite Mark. What is the expected turnaround between vacancy and re-rental?
I think that depends. I know it depends. And I can let Lisa touch on this too. But it depends on what needs. Go ahead. You can take it, Lisa. Lisa, go ahead.
Yeah, no, you're right. It definitely depends. What we do when there's a vacancy is we'll go in and evaluate and set a time frame. And it's typically within 2 weeks. We try to make it, sometimes it's an easy turn and we can do it in 3 days. But definitely within 2 weeks, unless it's a huge project. But, going through every single unit, we actually didn't find any units that we feel are going to be, more than a 2 week turnaround time. But like I said, that's a maximum. And we are working on pre-leasing as soon as the vacancy, or sometimes actually as soon as we have the notice. So, typically, especially if we already know that we've got it pre-leased, we would push people to get it ready even faster than that.
Awesome. Stephen and Thomas, you guys were asking about the exit risk and exit strategy. I think we hit on that, but let me know if you still have specific questions around that. Otherwise, I think we answered those. I think a lot of them I'm reading through, and I think we answered most of them as we answered one, we kind of expanded. So if you guys, if we didn't answer your question yet, go ahead and put it in again. And we'll try to hit on it again. Otherwise, I think we might have hit everything. Okay, here. The housing market in the DFW area, are houses cheap enough that tenants will move on out of apartments into single family homes? I can tell you that, and then I'll let you guys answer this from what you're saying, but what I'm seeing is that people who bought single family homes as rentals, like as investment properties. So like here in Silicon Valley, a ton of people bought single family homes in the DFW area as investment properties, as rental properties. And I've seen a ton of people selling them now because they're selling for so high that they're like, I am cashing out. So what I'm seeing is that is actually the single family home market has gone up, which would be good for us. But Tyler, what are you seeing in the space? Because that's anecdotal. It's not data driven, my answer.
No. But it's true, right? It's all, so there's this temporary, inflation within single family houses right now. It's just been booming, right? Housing prices increasing, but we look at metrics like that as far as, affordability, the affordability gap. And in fact, I mentioned this earlier with the price to rent ratio. We look to which the price to rent ratio, just as a quick review, is just measures affordability, versus renting versus buying in a given housing market. And we look for markets that have ratios above 10. And the DFW area, Fort Worth has 14. It's a, rent to price or price to rent. I can't remember the order of that, but rent to price or price to rent ratio of 14. Dallas is 16, well above 10. And also just demand is already just super, super, super high in the DFW area, just like well over national average. It's like 53% of the DFW area rents already. That's like, 33% nationally. So, I did see another one in there with, what's our thought on a market correction or a correction? A correction, I absolutely think that there'll be a correction. And that's a great thing for affordable housing. Apartments are one of the best affordable housing options out there. And in a correction, the demand for apartments doesn't decrease, it increases. And so we definitely think that the housing market is, what's the word I'm looking for? Fluffed. I don't know if that's the right word. It's early still, okay? Yeah. Fluffed a little bit, and we'll have a correction. But that is the risk there is the temporary risk, right? Is you have temporary turns, because even though the demand goes up, there will be people, in our frothy. I'm using frothy. Are
you dreaming of a latte?
I don't know. I just saw it in the chat. It made me just hit my funny bone. I loved it. We account for that within reserves, because the risk comes within the temporary turns. If some of our tenants lose their jobs, something like that happens, right? Has to move out, which certainly will happen. You have to be able to account for solid reserves, which is what we have there. And you have to have solid turn strategies, which we have. But the overall demand goes up, not down.
Yeah, and I want to touch on, because I see another question from Mark. How will new construction impact this property? So it's kind of along the same lines. So I don't remember how many years ago I went to Austin because I wanted to buy multifamily in Austin, and there was so much new construction around. And so I was like, oh, I'm going to back away from this market. There's too much new construction. There'll be oversupply. And someone, it may have been you, Tyler, but someone who is more experienced, that was just the beginning of my journey. Someone more experienced said, actually, what new construction, there's two things. It tells you that other like big developers, they're watching where the jobs go, and they're calculated, and they're only building where the jobs go. So they're very careful about their decisions. The local government only approves a certain amount, so it's not like a total free-for-all. And then also, if you have a brand new A property, like a brand new, really nice apartment building, and you have the one that's like a C+ that you're trying to make into a B-, my instinct was like, no one's going to want this. However, what I was told at that time, and then what I saw as a result, is that if you improve this to be like halfway there, then you can charge rents that are just a little bit under what the really nice one is. So it's like I'm going to say like the steak on the menu compared to the seafood, or is it like the other way around? Like if there's now something out there that's $500 more than your product, and you make your product nicer and you bring it up by $250, then you're still the affordable option. And so new construction actually can bring up the rent in the whole area. I saw that in Reno as well. I really wanted to get into Reno, and there is just a ton of new construction, and that's what it did. It actually raised the rents everywhere when that new construction came in, because the rent was high on that, and everyone kind of followed suit on that. So I'll let you touch on that as well, Tyler.
Yeah, no, first of all, it's a great answer. It is. You want to stay right below. But so, overbuilding is a big thing that we look at as well. But I'll mention, it depends on what stage you're at in the overbuilding, because as people are coming in and building, remember that brings in jobs, construction jobs. And those construction jobs are also great tenants. Those construction jobs last for a long time. Those are great tenants for us. So it actually, depending on what stage you're at, you're still there. But I'll give you the stat, market. So the DFW area, the market vacancy is a little over 5% market vacancy. It's like I want to say it's like 5.8%. So actually closer to 6% market vacancy. And there's a lot of new builds going on, a lot of apartments being brought to market. And the projection is that will raise about, I think it's like 60 basis points. I don't know if that's right. I think it's like the 6.2% or something is what that will raise the market vacancy to. And if you remember, we underwrote our property at 10% vacancy. So still very, very, very conservative numbers in relation to supply and demand. There's a lot of supply coming in. There's also still a lot of demand. Once again, it will uptick, but nothing even remotely close to what we've already accounted for within our projections.
Awesome. Yeah, I'm excited. A lot of people correcting my chicken versus the steak versus the ribeye versus London broil analogy. You guys got what I meant, though. There's another question from Mark. So since it's a new market, what's the status of your vendor contractor relationship? So for like the upkeep, the maintenance, the turns, that sort of thing.
It's not necessarily a new DFW. Yeah, go ahead.
No, go ahead.
So I'll let Lisa touch on this too, but we already own, I can't even remember how many properties. It's like 190 something units in the DF or the Dallas area, including Denton, which is just north of Dallas. But I'll tell you that even with that, Greg and Lisa we're very cognizant of that. Always building teams and connections. And it's one of the things that Greg and Lisa are way better than me at doing that. They are phenomenal at doing that. And so it's one of the reasons why they've been going back and forth to Dallas already even a couple times, is to not only build, new team members, but also vet the current ones that we have in place to make sure that they are up to Greg and Lisa's standards. Once again, they're very, very good at doing that. So I don't know if you want to touch on anything with that, Lisa, as well. But
yeah,
I know that. Yeah, go ahead.
Oh, I was just going to introduce Greg because he's actually with me now. So Greg is here, and he's actually kind of started on that. So here, everyone gets to hear Greg. Nobody ever gets to hear Greg, so this is a treat.
Material end of it, I've already gotten a hold of HD Supply, Chadwell, Lowe's, and I get extremely good prices with all of them. And we reached out to the representatives in that area as well, so we can get the same pricing. And then I'm working with Jay, which is our boots on the ground there as far as the vendors go, and we're going to start getting quotes and interviewing for all the positions necessary.
Love it.
Yeah, so basically we'll be able to take some of our, big relationships that we've already made, which we did the same thing when we moved into South Carolina. We had already created these relationships in North Carolina, and then, they want to be able to get the credit for bringing in big clients like us. So they're happy to refer to, whoever the person that we need to speak to or the people out in that other market. So, but we'll do the same thing also with individual vendors as well, just start interviewing. And one of the things that we are really big on is always getting 3 quotes for everything that we do, which keeps everybody honest and keeps everybody, competitive.
Mm-hmm. Love it.
And I'll mention something along that lines to kind of help you understand dedication to not just this property, but the market as a whole, because we actively want to expand. Jay, he's one of our partners who will be moving and relocating from California to Dallas to be boots on the ground, because we plan on, once again, actively expanding within that market. And so he'll be there. Once again, it's one of the things we benefit so much from with Lisa and Greg out in the Carolinas is the same thing, that Jay will be there doing that. And Greg and Lisa, coaching him and overseeing all those things all the time to make sure that it's continued to, be to the level that we have in the Carolinas as well. So it's a huge aspect. I can't believe we haven't even mentioned that, but yeah, moving to Dallas to, help expand and create that infrastructure, which is awesome.
Yeah, I love that. I'm excited to have Jay to partner with Jay on this too. And I want to expand on something that Lisa and Greg were saying. So like in the summertime, I think it was last year. So early days of the pandemic, there were supply shortages for building. And so I have a property in Columbia that's not with Greg and Lisa, and we were not able to get supplies. It was in that partnership, we didn't have like the local clout. And so our business plan was really behind schedule, and it still is because of that. And so I asked Greg and Lisa, like, how's it going on your properties? And Greg's like, no way. No, but there's no shortage. Like, he was able to get what he needed when he needed it for his stuff. And I was like, okay. I think I'll partner with these guys next. So that benefit is real. Like, it's not just for, like when things are good, it's really beneficial when things are kind of going sideways in the economy and in the space. So I think it's beautiful, the relationships that you've built and that you can expand those with those national chains. Yeah.
Oh, we appreciate that. Well, and just to sort of touch on, when things are good, it's easy for everyone, but when things are challenging, you need to have operators that are, even if we didn't have experience with something, you put Greg and I and Ryan and Tyler and Jay and Sarah, and you put all of our heads together on any kind of challenge that comes up, and we have no anxiety at all of being able to solve problems. We're all problem solvers, so it's a lot less of a risk for us knowing that.
Yeah, and I've seen you guys creatively solve so many problems in the past, so so I love working with you guys, of course. All right.
It's that dedication. There's so many questions around uncontrollables. And we, I don't want to discredit any of those things or act that we make light of any of those things, because we don't. It's our job to, once again, mitigate risk, right? Real estate's a risk. Our job is to mitigate the risk. But it's also our job to focus on the controllables, where people will get really where people will go astray, not just in investing and operations, but in life, is trying to control uncontrollables. You can't. But what happens is here's the thing, uncertainty, right? It's all external. It's all external. So what most people do when something like that happens is they focus on all these uncontrollables, which makes them more uncertain and feel like, a victim in whatever circumstance they're in. But the key is to focus on, the Navy SEALs call it a 3-foot world, which is, what can I control right now, right? With everything that's going on, this has served us so well over the past year, with the pandemic, is what can I control right now? And then your mind goes to work answering that. You answer it. Now, what do? When you do that, right, and you take action, you have movement. And then you ask the same question again, what can I control right now? And that's how you have forward momentum and forward progress. It's not that you discredit the uncontrollables. We account for those in our projections. But listen, projections, there's a lot of things, right, that can go, that don't go according to plan. Things never go as planned, right? But the key behind good operations is continually focusing on what you can control to increase your certainty, to increase movement, never staying bogged down in uncontrollables. So,
yeah, that's probably the most important thing you said today, Tyler. It's true. It's totally true. That nothing ever goes 100% according to plan. So to have a creative and committed team. And also, you guys, I represent like the investor relations arm of this partnership. So I'm always like, what other partners are so committed to doing what's right by investors? And this team is so committed to doing what's right by investors. Like, if there's something that's going sideways on another project, it's like, wow, what's the best thing we can do for the investors? That's always like, we want to do what's best for the investors, make them happy at all costs almost. Yeah. So, okay. We are getting to, I think we got most of the questions now. A question around accredited versus non-accredited and why we decided. So the only difference is it doesn't make any difference to the property or the project plan or anything like that. It just means, can we talk about it publicly? So if it's a 506C, I can post it on social media. I can talk about it on LinkedIn and boast about it, which is really fun. And so the decision between 506C or 506B for accredited or non-accredited, it doesn't have anything to do with the deal. It's usually like, who do I know is ready to invest? And so that I can know to like place the right people in the right project. So the last ones that we did were 506B for anyone, sophisticated investors as well, as long as we knew each other. And so this one we decided to do a C, just to see what it feels like to be able to boast about our great project out there. So if that answers pros and cons, there aren't really pros and cons for the investor, except for whether you can invest or not. It doesn't affect the business plan or the projections or anything. All right. So did you see any that we didn't miss, that we didn't get to, Tyler?
I don't think so.
Okay.
I think we're good.
Cool, Stephen. I'm glad. It was great to have you. Thank you for your questions. Glad we answered the questions. And yeah, so you guys can click on that link, place your soft reserve, and then you'll get an email when the next steps are ready. And we still have room for a few more. It's a really big raise, 8.8 million. So we still have room for people. If you have friends and family as well who want to invest, pass on this investment to them. That's also the beauty of a 506C is, you have a brother, a sister, a mother, a niece, nephew, a colleague. You can share this with them. And you can say, look at this great thing I'm investing in. You want to join in on the good returns. So Yes, Rose, go ahead and give me a call because I know you had some questions too. So with that, I think we'll wrap it up, and I'll say thank you so much to Tyler and Lisa and Greg for the last couple hours of talking. And I hear your voice is starting to shift, Tyler. So thank you for that time, and thank you to all the investors who stayed on for so long. And yes, there will be a replay. I've been recording. I'll send it out later today, and make sure everyone has the links. You're welcome, Matt. And yes, Matt, go ahead and give me a call. You said you had some additional questions. So you guys feel free to give me a call with additional questions. The replay will be out there. We still have time to talk about it. So sounds great. All right. Have a beautiful Friday. Have a beautiful weekend. Thank you, investors. Thank you, Tyler and Lisa, again.
Thank you, Sarah. Appreciate it. Thanks, Lisa. Thanks, y'all. Take care.
Take care. Bye-bye.
Bye. Happy weekend.